14 days. I mean, according to the stack of data and forensic financial analysis we are looking at today, that's exactly how much time it takes.
Right, just 2 weeks.
Yeah, exactly. 2 weeks for the absolute smartest money on earth to, quietly exit a burning economy before the smoke alarms ever even go off. So, welcome to the deep dive.
Glad to be here for this one.
Usually when we talk about a major market crash, there is this, this expectation of chaotic economic weather.
No, definitely, like a sudden storm.
Right. You flip on the financial news and the pundits on TV, they treat a sudden plunge in the stock market like a hurricane that just formed off the coast.
Yeah, exactly.
They point to the giant red arrows on screen and say, look at this unpredictable storm we are caught in. It is completely framed as an act of nature.
It is. Well, it's a very comforting narrative, honestly.
Yeah.
I mean, we like to believe that if the market drops 20%, it's just atmospheric pressure in the economy rebalancing itself. It makes the chaos feel organic and crucially unavoidable.
Right. Like nobody's at fault.
Exactly. But the reality painted by our sources today, it just shatters that illusion completely.
Yeah, it really does.
And our goal today isn't to give you financial advice. It's to expose the actual hidden plumbing of global finance. For you, the listener, understanding how these massive entities actually move, it's the only way to make sense of modern wealth distribution.
Absolutely.
Because if you don't grasp the engineering behind the system, you will always be, kind of a victim of its cycles.
Okay, let's unpack this. Because the mission for today's deep dive is to explore this fascinating set of documents outlining a really precise 14-day window of, absolute silence right before a major market collapse.
14 days of silence.
Right. The source suggests these crashes are not random storms at all. They are tightly engineered events. The clouds are seeded, the precipitation is calculated down to the decimal point, and the umbrellas, they're handed out to a very select few.
To put it mildly, yeah.
To understand how they pull this off, we really have to look at what the public sees versus what the actual data shows, starting right at the beginning of this window, day one. And on day one, the public sentiment is, it's absolute euphoria.
Oh, complete euphoria. The Federal Reserve is releasing statements about continuing quantitative easing, and we will get into the mechanics of that shortly.
Right, the money printer.
Exactly. They are signaling that the money printer is staying on. Major indices are hitting all-time highs. And if you monitor the financial media during this specific phase, they are actively encouraging everyday retail investors to, increase their leverage.
Wow.
Yeah, they are telling the public to borrow money and buy more stock because the bull market is supposedly endless.
Which brings me to an analogy that completely rewired my brain while I was reading this stuff.
Oh, the ocean liner thing?
Yes.
Yeah.
I always pictured sovereign wealth funds and these hyperscale asset managers as these massive, slow-moving ocean liners.
Yeah.
You figure it takes $1 trillion fund, weeks just to turn the ship around, right?
That's the common assumption, yeah.
But the sources show that behind closed doors, they do not operate like ocean liners at all. They function way more like a synchronized swarm of high-frequency trading drones.
That visual is just spot on because agility is their actual weapon.
Right.
By day 3 of this 14-day window, while the retail investor is aggressively buying the hype, the institutions begin a highly synchronized liquidation event. They basically start dumping their assets.
Okay, let me stop you right there because my brain is breaking a little bit.
Sure, go ahead.
If an institution dumps hundreds of billions of dollars worth of stock, the price should instantly crater. The supply would totally overwhelm the demand and everyone would panic. How do they pull the plug without the water swirling down the drain?
Well, they utilize a mechanism known as algorithmic arbitrage.
All right.
Rather than placing a single massive sell order, these entities deploy highly advanced quantitative bots. These algorithms take a market-moving sell order and literally slice it into millions of tiny microtransactions.
Just dicing it up?
Exactly. And then they execute these fractions of a trade simultaneously across dozens of global exchanges.
So it's atomization.
Yeah.
Meanwhile, my banking app takes 3 business days just to clear a $5 coffee purchase. And these algorithms are conducting millions of trades across the globe in milliseconds.
Right. And the scary part is it is entirely invisible to traditional volume trackers.
Seriously?
Yeah. The trackers just read it as normal everyday market noise. And the real key here is who they are selling to.
Right. Who's buying all this?
The algorithmic bots are actively hunting for the buy orders placed by those optimistic retail investors we just mentioned.
Oh,
They are systematically transferring their overvalued assets to the public. They effectively use the everyday investor's buying pressure to quietly absorb their massive exit.
Man. Here's where it gets really interesting, though, because I'm looking at the macro data. And if the market is at all-time highs and everyone is making money, why are the smartest, most well-funded algorithms on Earth rushing for the exits in the first place?
It's a great question.
Like, what do they see in the math that the public isn't seeing?
They see the structural limit of something called synthetic liquidity.
Synthetic liquidity.
Yeah. This is where we have to look at the actual plumbing of the system. When the general public looks at the stock market, they see high trading volume and assume, it means the underlying economy is fundamentally healthy.
Right, lots of buying means good things.
Exactly. But the quantitative models used by elite asset managers map the reality of the capital itself. They recognize that the money propping up the market isn't genuine economic growth. It is phantom capital.
Phantom capital. Okay, break down the mechanics of that for me. How does money actually become phantom?
It is the mathematical byproduct of two things colliding: a fractional reserve banking system and quantitative easing.
Okay, let's take those one at a time.
Let's look at the fractional reserve part first. When you deposit $1 in the bank doesn't keep it in a vault. They are allowed to lend out, say, 90 cents of it.
Right, standard banking.
The person who borrows that 90 cents buys something, the seller deposits that 90 cents in their bank, and that bank lends out 81 cents. This cascades until one actual physical dollar has been mathematically stretched into $10 of purchasing power in the market.
So the system is inherently leveraged just by existing.
Exactly. Now, pour quantitative easing on top of that.
Oh boy.
The central banks start creating billions of dollars out of thin air to buy government bonds, which suppresses interest rates and floods those banks with new cash.
And the banks just multiply that too.
Right. The banks aggressively apply their fractional multiplier to this new cash, flooding the stock market with capital. But it's synthetic. It isn't built on companies actually producing more goods or services. It is literally just debt piled on top of printed money.
Wait, so the money keeping the market afloat is essentially a holographic projection.
Mm-hmm.
And you were saying these quantitative models have the computing power to calculate exactly when the projector is going to run out of power.
That is a perfect way to phrase it. They map the mathematical limits of that leverage.
It's insane.
The algorithms continuously calculate the structural integrity of the synthetic liquidity. They know exactly how much phantom capital is in the system, and they calculate the precise moment that the multiplier effect will stall and the liquidity will evaporate.
So that's why they start the sell-off.
Yes. They initiate the swarm on day 3 because they know the hologram is flickering.
But logically, if I know a catastrophic market crash is days away, my very first instinct is just to sell everything and sit in cash. Put it in a checking account, stick it under a mattress, whatever. Why don't these multi-trillion-dollar funds just move everything to pure cash?
Well, because of the footprint.
The footprint.
Moving trillions of dollars into pure cash creates a massive, undeniable distortion in the banking system. If the central banks suddenly see trillions of dollars being hoarded and removed from circulation, it sets off the exact alarms these institutions are trying to avoid.
Ah, I see.
They would trigger the panic before they finish getting their money out.
So if they can't go to cash because it'll set off the alarms, where does the $1 trillion actually hide? They have to find something liquid enough to absorb the money, but boring enough to not make headlines.
Which is exactly what we see in the data around day 7. The algorithmic flow quietly redirects all that newly freed up capital into highly specific defensive instruments. We are talking about short-term government bonds, heavily guarded physical commodities like gold, and crucially, derivative contracts.
Let's talk about those derivatives, because looking at the sources we have, they aren't just buying insurance. They are aggressively weaponizing their position.
Oh, absolutely. They are purchasing complex financial instruments designed to exponentially profit from downward volatility.
Which means betting on the crash.
In simple terms, they spend the first week pumping the market up and feeding their shares to retail investors, and then they spend the second week quietly placing massive bets that the exact same market will crash.
They're shorting the house right after they sold it to you. It is ruthless efficiency. And according to the timeline in the documents, by day 12, this mathematical transition is completely finished.
Completely done.
The sovereign wealth funds and the elite asset managers have fully rotated their capital. They are entirely insulated, and they have actually positioned themselves to multiply their wealth when the floor falls out.
The trap is fully set at that point. All that is required now is a catalyst to force the market to acknowledge reality.
Which brings us to the end of the window. Day 14. The everyday investors are holding all these overvalued assets. They are highly leveraged on margin because the TV analyst told them to be, and then the spark happens.
The trigger.
Right. And the sources note that the trigger itself barely matters. It could be a geopolitical skirmish making headlines, a major tech company missing an earnings report, or, I don't know, a central bank official using a slightly hawkish tone in a press conference.
This specific event is irrelevant. It is just the excuse the market needs to reprice itself.
It was already baked in.
Exactly. The structural collapse was already guaranteed the moment the mathematical limits of the synthetic liquidity were reached.
Now, I really want to dive into a tension within the sources here, because there is a serious debate among analysts about the intent behind all of this.
Right, the intent question.
Yeah, the documents present a defense from some institutional economists who claim this isn't some coordinated, smoky backroom conspiracy. They argue it is an emergent property of complex systems.
Which is the sanitized corporate defense.
Totally.
The argument goes like this. If you have thousands of independent, highly rational algorithms all reading the exact same macroeconomic data regarding synthetic liquidity, it makes mathematical sense that they would all arrive at the exact same logical conclusion to de-risk at the exact same time.
So they claim it's natural.
Right. Under this theory, the synchronized liquidation isn't predatory, it is just a coincidence of mathematics.
I am going to push back incredibly hard on that emergent property theory, and honestly, the sources give us the receipts to prove it's nonsense.
Let's hear it.
If this is just a bunch of bots independently doing math, how do you explain the research reports? During this exact same 14-day window, while their algorithms are silently dumping everything, the public-facing research arms of these very same institutions are publishing aggressively bullish reports. They are going on financial networks, predicting 20% upside to keep the retail investor buying.
The discrepancy between public messaging and private action is the absolute key to understanding the architecture here.
Exactly. The retail investor isn't an innocent bystander in a complex system. They are mathematically required to be the exit liquidity.
They need you to buy.
Without the retail buyer believing the optimistic PR, the giant funds couldn't execute their algorithmic arbitrage. They literally need you to buy so they can sell. It is a game of musical chairs where the institutions own the stereo, they are the only ones who can see the timer, and they are telling everyone else to keep dancing.
And if you want forensic, undeniable proof of that intent, the sources point us directly to the SEC filings.
The receipts.
The literal receipts. If you pull the Securities and Exchange Commission Form 10K filings for the major banking institutions from the quarter of a major crash, the data is staggering.
I was actually looking at the 10K data you pulled for this, and the math is wild. Right in the middle of this 14-day window, these major banks drastically slash their prime brokerage exposure. Essentially, they are cutting off margin lending to mid-tier funds.
And let's translate what cutting off margin lending actually does. Margin is the borrowed money that fuels market buying.
Right.
By restricting those loans, the big banks actively starve the market of capital. They aren't just predicting the burst of the synthetic liquidity bubble, they are actively taking a pin and popping it themselves to ensure the collapse happens exactly when they are safely positioned for it.
Their own self-preservation guarantees the destruction of everyone else. And the forces point out another layer to this structural disadvantage, the front-running.
Oh, this is the really futuristic part.
Yeah, they talk about algorithms using probabilistic futures generated by quantum-adjacent computing, which, I mean, it sounds like science fiction. Walk me through the actual plumbing of how a bot intercepts a trade.
It is the cutting edge of quantitative finance. Imagine you see a positive news headline and you tap buy on your phone.
Simple enough.
That signal takes a fraction of a second to route through fiber optic cables to the exchange. In that microscopic window, institutional algorithms intercept the data packet. Because they have quantum-adjacent computing power, they instantly calculate the probable future price movement based on your incoming order.
In a fraction of a second.
Yes. The algorithm buys the stock milliseconds before your order officially executes and then instantly sells it to you at a microfraction of a higher price.
So I am trading based on the news I just read.
Yeah.
But the institutions are trading on the literal future, effectively taxing every single transaction I make.
Precisely. You are permanently structurally disadvantaged.
So what does this all mean for you? If the entire architecture of global finance is inherently designed to use everyday learners and investors as exit liquidity, How can an independent observer possibly defend themselves? We obviously can't build our own quantum-adjacent supercomputers in the garage to compete.
No, we can't. But the actionable takeaway from the sources is a complete behavioral shift.
Okay, what do we do?
You have to stop looking at mainstream corporate earnings reports, and you have to ignore the PR firms on financial news networks entirely. To survive, you must monitor what the institutional algorithms are monitoring. You have to track the macro indicators of synthetic liquidity.
The sources list a few specific metrics. Let's make sure these actually make sense. First, they say to monitor bond market yield curve inversions. That sounds like absolute Wall Street word salad. What actually is that mechanically?
Right. It sounds complicated, but a yield curve inversion is essentially a massive red flag in the bond market.
Oh.
Normally, if you lend the government money for 10 years, you expect a higher interest rate than if you lend it to them for 2 months because your money is locked up longer.
That makes total sense.
But an inversion happens when short-term bonds suddenly pay more than long-term bonds.
Wait, why would that happen?
That only occurs when the smartest money in the world is so utterly terrified of the immediate future, like the next few months, that they demand a massive premium just to hold short-term risk. It signals systemic distress long before the stock market reacts.
Okay, that makes sense. The second metric they mention is watching reverse repurchase agreement volumes at the central banks. Again, jargon. What is a reverse repo?
Think of it as a massive, heavily fortified overnight parking lot for cash.
A parking lot?
Yeah. When major institutions are too terrified to invest their billions in the stock market, but they can't just hoard cash because of the footprint we discussed earlier, they park their money at the Federal Reserve overnight in exchange for absolute safety.
Ah, I see.
If you see the volume in that reverse repo parking lot suddenly spike into the trillions, it tells you exactly what the institutions are doing behind closed doors. They are hiding.
And the third metric is watching for subtle shifts in sovereign wealth fund asset allocations. Basically tracking when nations start moving their GDP into the defensive postures we outlined earlier, like gold and short-term debt.
Exactly. When you see these true underlying liquidity metrics diverging wildly from the high prices of public stocks, that is the mathematical signal to head for the exits yourself.
It is about learning to read the invisible ink on the ledger. I mean, it takes a tremendous amount of psychological discipline to ignore the loud, euphoric noise of the television telling you everyone is getting rich, and instead recognize the silent transition from a risk-on environment to defensive posturing.
It really does. That discipline allows you to stay skeptical, vigilant, and aware of how the plumbing actually functions. You stop reacting to the weather, and you start watching the barometer.
Because ignorance of these mechanics, the fractional reserve multiplier, the algorithmic arbitrage, the synthetic liquidity, it isn't just a blind spot anymore. It is an active vulnerability.
Absolutely.
When a crash happens, the market isn't weathering a storm. It is executing a highly controlled, mathematically precise transfer of wealth from the bottom to the top.
And as long as the underlying architecture remains unchanged, the cycles of inflating the synthetic bubble and deflating it at precisely the correct moments for the institutional architects will only continue. The models driving this wealth extraction are running flawlessly.
Which leaves me with a final thought for you to chew on. Let's say everything we've talked about today becomes common knowledge.
Okay.
If retail investors become educated en masse, and suddenly everyone with a brokerage app starts tracking these obscure institutional metrics, monitoring the reverse repo parking lots and watching the yield curves, what happens next?
That's the real question.
Will the institutional algorithms simply adapt? Will they engineer a new, even deeper, more complex layer of synthetic shadow metrics to hide their tracks? Are we locked in a perpetual, never-ending arms race of financial data where the finish line constantly moves the moment we figure out the rules of the game?
It's a terrifying thought.
It really is. Keep your eyes open, and remember, the next time someone tells you the market is just experiencing a little bad weather check, who is holding the umbrella. Thanks for joining us on this deep dive.